Hi guys! Enjoy John's analysis.
Look, I need you to stop scrolling for the next minutes. I mean it. Whatever you're doing right now, whatever tab you have open next to this one, close it. Because in about 4 minutes, you're going to make a decision that either saves you or costs you money you don't even know you're about to lose. Every time Bitcoin drops, the same two groups show up. One screams, it's going to zero. The other screams, to buy the dip. Neither one has ever once checked the actual data before opening their mouth. And tonight is no exception. Bitcoin just dropped to $62,263. That is a 3.3% move in 24 hours, and it is verified across CoinDesk, CoinMarketCap, and Yahoo Finance as of this recording. Numbers like that do not need exaggeration. They need context, and almost nobody watching this right now has the context. Somewhere tonight, a long-term holder is staring at a portfolio app, watching the green numbers turn red and feeling something tighten in their chest. That feeling is real. It is also, historically, the single most expensive emotion in this asset class. Before we get into the data, here's something kind of fun. One of the best parts of running this channel is seeing how global this audience actually is. People watching this exact sentence right now from completely different time zones, completely different weather, completely different lives. So drop a comment with your city, what time it is for you right now, and what the weather's doing outside. It only takes a second, and it's always wild scrolling through the replies later and seeing just how spread out this community really is. And don't forget to like and subscribe. Appreciate that. Well, this is not a video about whether Bitcoin goes up or down from here. Nobody honest makes that call, and anyone who does is selling you something other than the truth. This is a video about what holders are doing right now, in this exact moment of fear, and why most of them will look back on this week and recognize a mistake they could not see while they were inside it. We are going to walk through the verified data together. Price action, sentiment indicators, on-chain behavior, the macro backdrop driving this move, and what the largest corporate holder on Earth did in the last 7 days while retail was panicking. Then we are going to talk about the part nobody wants to admit, the gap between how you think you would behave under pressure and how you actually behave. Stay through the whole thing, because the bear case gets a fair hearing in every section. This channel does not hide the downside to make a point. If the point only survives by hiding half the evidence, it was never a strong point to begin with. You think you know how you'd react if this kept falling. Most holders think that right up until the moment it actually happens, and then they discover the version of themselves they imagined under pressure was never real. There's a 2-minute diagnostic making the rounds right now called Diamond Conviction Test. Yes, a simple quiz. Not a forecast, not a signal. Just 10 questions that expose how your conviction actually behaves under stress instead of how you assume it behaves. It doesn't tell you what Bitcoin will do next. It tells you what you will do next, which historically has been the more expensive unknown. The link is in the description and in the comments, but don't go take it yet. Finish this video first, because the next few minutes are about to tell you exactly why most people's answer to that quiz won't be what they think it is. Then come back and drop your result in the comments. Just the category, nothing else needed. Now, let's get into what actually happened in the last 24 hours, because the data tells a very different story than the panic does. Let us establish the facts before anything else, because facts are the only thing that matter once panic enters a market. As of this recording, Bitcoin is trading between $62,263 and $62,421. That range is confirmed independently across CoinDesk, CoinMarketCap, and Yahoo Finance, 3 sources that rarely agree on exact decimals, but agree completely on the scale of this move. The decline over the trailing 24 hours sits between 3.3 and 3.5%. That is not a flash crash. That is a steady, grinding decline of the kind that erodes confidence slower and more effectively than a single violent drop ever could. Slow bleeds are more dangerous to holder psychology than fast crashes, because fast crashes trigger adrenaline, and adrenaline passes quickly. Slow bleeds trigger doubt, and doubt does not pass on its own. It compounds, hour after hour, until a holder convinces themselves that selling is the rational choice rather than the emotional one. Notice also what this move is not. It is not accompanied by any single catastrophic headline. No exchange collapse, no regulatory ban, no exploit. A decline with no singular cause is, by definition, a sentiment-driven decline, and sentiment-driven declines behave very differently from event-driven ones. Here is the bear case, stated plainly. Because we are not in the business of hiding the downside. If this level fails to hold, the next structurally significant zone sits meaningfully lower, and nobody can promise you it will not get there. We are not telling you this will bounce. We are telling you what the data says right now, and the data says this is a test, not a verdict. There's a number circulating in trading circles right now that most retail holders have heard of but never actually studied, the 200-week moving average. Right now, it sits in the neighborhood of $61,000, and Bitcoin is testing it directly. This line has acted as a major support zone across multiple prior cycles, verified through CoinGlass and BitBo charting data. What makes this line significant is not mysticism, it is structural. A 200-week average smooths out nearly 4 years of price action into a single line, which means when price touches it, you are looking at a multi-year average cost basis for an enormous portion of the market. In prior cycles, when price approached this exact line, two very different groups of people made two very different decisions. One group sold in fear, convinced the line would not hold this time. The other group bought, treating the test of the line as the opportunity rather than the threat. The reason this line keeps reappearing in cycle after cycle is not coincidence. And it is not because some chart-watching community willed it into relevance. It reappears because a large enough share of long-term holders use roughly that horizon to judge whether their thesis is still intact. And when price sits near their average entry, behavior tends to bifurcate sharply between conviction and capitulation. Now for the bear case, because this line is not magic, and it has broken before. Moving averages are descriptive, not predictive, and a strong enough wave of selling can push price through any historical support level, regardless of how many times it has held in the past. Anyone telling you this line guarantees a bounce is selling certainty in a market that has none. While sentiment swings violently in either direction, the underlying issuance schedule of this asset does not swing at all. New supply enters the market on a fixed, pre-programmed curve, and that curve does not accelerate during fear or decelerate during greed. This is worth saying out loud because almost none of the panic commentary circulating right now even mentions it. A fixed supply curve does not, on its own, determine price, and treating it as if it did would be a logical overreach. What it does mean is that every single buyer or seller this week is transacting against a known, unchangeable issuance rate, not against a supply that can be expanded in response to demand the way many other assets can be. That structural property does not disappear just because sentiment is currently negative. This matters for context, not for prediction. Holders panicking over a short-term price move are reacting to demand-side noise layered on top of a supply schedule that has not changed at all this week, last week, or this year. Understanding which side of that equation is actually moving helps separate what is genuinely new information from what is simply emotional amplification of an old, known fact. The bear case belongs here too, because a fixed supply schedule cuts both ways. It guarantees scarcity on the supply side, but it offers zero protection against a genuine collapse in demand. And demand is precisely what looks fragile when sentiment sits in extreme fear. Scarcity does not equal a price floor. It simply removes one specific failure mode that other assets are exposed to. Price charts only tell you what happened to the number. On-chain data tells you who is actually moving, and that distinction matters enormously right now. Long-term holder supply, meaning coins that have not moved in roughly a year or more, behaves completely differently from short-term holder supply during a decline like this. Short-term holder supply tends to be the first to panic because those coins were bought more recently, often closer to current price, and the psychological pain of a fresh loss is sharper than the pain of an older one. That group is generally responsible for the bulk of reactive selling during exactly this kind of grinding decline. Long-term holder supply, by contrast, tends to remain remarkably stable through these exact windows, sometimes even contracting as coins move into colder, longer duration storage. This split matters because it reframes who is actually driving the price action you are watching. It is rarely the disciplined multi-year holder selling into extreme fear. It is much more often the newer entrant who bought during a stronger rally, watched the position go red, and is now exiting at a loss into the very weakness that long-term holders are simply absorbing. The bear case here is straightforward and worth respecting. On-chain stability among long-term holders does not prevent further downside on its own, because price is set at the margin by whoever is actually willing to transact, not by who is sitting still. A market can keep falling even while the majority of supply does not move an inch. The Fear and Greed Index, a widely tracked sentiment gauge for this market, currently reads between 21 and 23. That range is classified as extreme fear. This is not a vibe or an opinion. It is a calculated composite of volatility, momentum, social sentiment, and market dominance, and it is sitting near the low end of its own scale. Extreme fear readings are rare, and that rarity is exactly why they matter. A market does not reach extreme fear because of mild concern. It reaches extreme fear because a meaningful percentage of participants have shifted from rational analysis into emotional reaction. An emotional reaction is loud, fast, and frequently wrong. Walk through any social platform discussing Bitcoin right now, and you will find the same emotional pattern repeating. Long-term holders describing the drop as gut-wrenching, others questioning years of conviction in a matter of days, and a general tone that this time feels different from every other test this asset has survived. The last phrase, "this time feels different," deserves attention on its own because it shows up at nearly every major drawdown in this asset's history. It felt different in 2018. It felt different in 2020. It felt different in 2022. The feeling is not evidence. It is simply what fear sounds like when it is fresh. The bear case here deserves equal airtime. Extreme fear does not have a built-in expiration date, and sentiment can stay depressed for weeks or months if the underlying macro picture continues to deteriorate. Anyone promising you that extreme fear always precedes a bounce is rounding off a tendency into a guarantee, and guarantees do not exist in this market. There's a reason headlines built around the word crash spread faster than headlines built around nuance, and it has nothing to do with which story is more accurate. Fear is a stronger trigger for engagement than context, and platforms are optimized to reward whatever triggers engagement fastest. That incentive structure exists independent of whether the underlying asset is actually in trouble. This creates a feedback loop worth naming directly. A modest decline gets framed in maximally dramatic language. That framing spreads faster than calmer analysis. More viewers arrive already primed for fear, and the emotional temperature of the conversation rises well beyond what the actual price move would justify on its own. None of this requires bad intent from anyone involved. It is simply what happens when an incentive system rewards alarm over accuracy. Recognizing this loop does not mean dismissing real risk, and it should not be used that way. It means holding two facts at once. The decline is real and verified, and the emotional intensity surrounding it is partly a function of how attention economics work, not purely a function of how dangerous the moment actually is. The bear case still belongs here too. Sometimes the loud, dramatic framing turns out to be directionally correct, and dismissing alarm as mere engagement bait is its own kind of bias. The goal is not to ignore fear, it is to separate the signal inside it from the volume around it. Part of why a 3 to 4% move can feel so much larger than the number itself suggests comes down to leverage sitting inside the broader derivatives market. Traders using borrowed capital to amplify a position get forcibly closed out once price moves against them by enough. And those forced closeouts are themselves sell orders, regardless of whether the trader wanted to exit. That mechanical selling adds pressure on top of whatever organic selling started the move in the first place. This is a structural feature of leveraged markets, not a Bitcoin-specific flaw. And it shows up in every asset class that supports significant derivatives trading. The practical effect is that a relatively modest spot price decline can trigger a cascade of forced liquidations, which then pushes price down further and faster than the initial move alone would have justified. Once that cascade finishes clearing, the market is often left at a level that reflects exhausted leverage rather than genuine consensus about fair value. Recognizing this mechanism matters because it explains why declines often look sharper in the moment than they look a few days later, once the leveraged positions have been flushed out. None of this tells you whether the flush is finished or whether more remains. It simply explains part of the mechanics behind why fear can spike harder and faster than the underlying news would otherwise justify. The bear case here is direct. Leverage cascades can also mark the beginning of a larger move rather than the end of one, particularly if the broader macro backdrop keeps deteriorating and fresh leverage positions keep entering on the short side. There's no reliable way to know from the outside, in real time, whether a given cascade is nearly finished or just getting started. We are going to pause the narrative here and give the bear case its own full hearing, uninterrupted, because a video that only platforms one side of an argument is not analysis, it is marketing. The macro backdrop driving this decline includes real outflows from spot Bitcoin ETFs, real risk-off behavior across broader markets, and real uncertainty that has not resolved itself. None of that is manufactured, and none of it should be waved away. If outflows continue at pace, and if broader risk appetite keeps deteriorating, there's a credible path to this decline, extending well beyond the 200-week line. Liquidity can evaporate quickly in a market this size, and quick evaporation can turn an orderly test of support into a disorderly break of it. That is the honest, unhyped version of the downside. It is also worth saying plainly that conviction itself is not a strategy. Holding through a decline simply because previous declines eventually recovered is reasoning by analogy, not reasoning by fundamentals. And analogies fail exactly when conditions genuinely change. A holder who never reassesses their thesis is not disciplined. They are simply inflexible, and inflexibility carries its own risk profile. We are not going to tell you this is the bottom, because nobody making an honest video can know that. What we can tell you is what the largest, most transparent, most regulator-scrutinized holder of Bitcoin on the planet chose to do this week, while retail sentiment was sitting in extreme fear. That is not a prediction. That is a documented fact, and facts are what the next section is built on. Bitcoin does not move in a vacuum, and pretending otherwise produces shallow analysis. The current decline is unfolding alongside genuine risk-off positioning across broader markets, with capital generally rotating toward perceived safety rather than toward speculative or growth-oriented assets. That backdrop affects every risk asset simultaneously, not just this one. When the broader environment turns risk-averse, Assets with shorter trading histories and higher volatility tend to get sold first and hardest, simply because they carry the largest perceived uncertainty premium. Bitcoin, despite more than a decade of existence, still gets priced by much of the market through that lens. That is a structural reality of where this asset sits in the broader risk spectrum today, not a flaw unique to it. This matters because it reframes the question most holders are asking incorrectly. The question is rarely whether Bitcoin specifically broke something. The more accurate question is whether risk appetite broadly is breaking, and Bitcoin is simply moving with that tide along with everything else carrying similar risk characteristics. The bear case belongs here as well. If the broader risk-off backdrop deepens into something more structural rather than a temporary wobble, Bitcoin has no historical precedent for being immune to that kind of macro deterioration. Correlation with broader risk assets has increased over time, not decreased, and that trend itself is a legitimate long-term concern worth tracking. It is worth glancing sideways at how other major asset classes are behaving during the same window, because Bitcoin's decline does not exist in isolation from the rest of the financial system. Broader equity indices and traditional safe haven assets are both showing their own signs of repositioning right now, reflecting the same underlying risk-off sentiment rather than anything specific to crypto markets. That context matters because it suggests this week's move is participating in a broader market mood rather than responding to some isolated failure unique to Bitcoin itself. This does not excuse the decline or argue that it should be ignored simply because other assets are moving too. It does argue against treating this week's price action as a referendum on Bitcoin's fundamentals specifically, when the more accurate read is that capital broadly is repositioning away from risk across multiple asset classes simultaneously. Singling out one asset for blame in a broad risk-off window is a common but misleading framing. The bear case closes this section honestly. If this risk-off mood is the early stage of something larger and more sustained across markets generally, Bitcoin's higher historical volatility means it could continue underperforming calmer asset classes through any continued deterioration. Participating in a broad market move cuts both ways, on the way down just as much as on the way back up. On June 22nd, Strategy disclosed a purchase of 520 Bitcoin for approximately $35 million, executed between June 15th and June 21st. This is not a rumor or an ex post. It is documented in an official 8K filing with the Securities and Exchange Commission, corroborated by direct statements from the company's founder, and reported independently by Bitcoin Magazine, Bloomberg, Yahoo Finance, and news.bitcoin.com. That purchase brings the company's total holdings to 847,363 Bitcoin. Read that number again. While retail sentiment sat at extreme fear and the social platforms filled with holders questioning their own conviction, the single largest corporate holder of this asset added to a position already worth tens of billions of dollars. This is not the first time this pattern has shown up. Across most of the meaningful drawdowns this company has lived through, the public buying pattern has leaned toward accumulating during fear rather than retreating from it, visible across years of regulatory filings rather than a single press release. That pattern is not perfectly unbroken, and the next section addresses the one documented exception directly, rather than leaving it out. What makes this disclosure different from a tweet or a forum post is the accountability attached to it. An 8K filing carries legal weight, regulatory scrutiny, and personal liability for the executives signing it. Nobody files paperwork like that with the SEC to manufacture a vibe. They file it because the transaction actually happened, on the date stated for the amount stated. Here is the necessary bear case, because even this fact has limits worth respecting. A single institution's conviction is not proof of anything beyond that institution's own thesis, and concentrated corporate buying carries its own risks if that company ever needs to unwind a position of this size. We are showing you what happened, not telling you to copy it blindly. A quick reminder before we keep going. The Diamond Conviction Test is still sitting in the description and pinned in the comments. Don't forget to actually take it once this video is over, while everything you just heard is still fresh in your head. Now, back to the data, because this next part is where it gets interesting. The phrase smart money gets thrown around constantly in this space, usually as shorthand for whatever large buyer happens to be doing something the speaker agrees with. That casual usage obscures a more precise and more useful definition. In any market, the participants commonly described as smart money are simply the ones operating with more information, longer time horizons, lower funding costs, and fewer emotional constraints than the average participant. None of those four advantages make a buyer infallible, and treating the label as a synonym for correct is exactly the kind of shortcut this video has been trying to avoid throughout. What the label does usefully describe is a difference in operating conditions, not a difference in certainty. A buyer with a longer time horizon and lower funding pressure can simply afford to be wrong for longer than a retail trader, using money they need access to on a shorter timeline. That distinction is the entire reason filings like Strategy's 8K carry more weight as a data point than an anonymous social media post claiming the bottom is in. It is not because the institution is smarter in some innate sense. It is because the institution's documented behavior reflects a different set of constraints than the constraints most retail holders are actually operating under, whether they admit it or not. The bear case belongs here too, plainly. Favorable operating conditions reduce certain risks without eliminating others, and an institution with a longer runway can still misjudge a macro environment as badly as anyone else can. Lower funding pressure buys time, not correctness. And the two get confused constantly in how this conversation gets discussed publicly. This is not a single data point in isolation. It sits inside a much longer pattern worth understanding. The honest version of that pattern includes a recent wrinkle worth naming directly. On June 1st, Strategy disclosed its first net sale of Bitcoin since December of 2022, offloading 32 coins for about $2.5 million to help fund a preferred stock dividend payment. That filing ended, on paper, years of public messaging built around the idea that the company would never sell. 3 weeks later, the company disclosed the 520 Bitcoin purchase covered earlier in this video. Read in sequence, the honest picture is not a flawless, uninterrupted accumulation streak. It is a company that sold a small dividend-driven amount, then resumed buying within weeks, while continuing to issue equity to fund both moves. That nuance matters, because presenting this as a perfect, unbroken pattern of conviction would be exactly the kind of selective storytelling this video has spent its entire runtime warning against. The earlier sale was small in size and explicitly tied to a specific cash obligation, not a change in long-term thesis. But it is still a documented sale, and pretending otherwise to make the contrast with retail panic look cleaner would be its own form of dishonesty. None of this erases the broader multi-year pattern of accumulation through prior drawdowns. And treating one small, explained sale as proof the entire strategy has reversed would be its own overcorrection. The bear case here is simply that even the most disciplined-looking institutional behavior is more complicated up close than it looks from a distance, and imitation without understanding the underlying cash mechanics is speculation dressed up as discipline. It is worth stepping back and asking why a publicly traded company would put Bitcoin on its balance sheet in the first place, since the answer clarifies why short-term price swings matter less to that buyer than they do to a retail trader. The publicly stated thesis behind treasuries like this one centers on using a fixed supply asset as a long-duration store of value, specifically as a hedge against currency debasement and the erosion of cash sitting idle on a balance sheet over many years. That is a multi-decade thesis, not a multi-week one. A buyer operating on a multi-decade thesis is, by construction, far less sensitive to a single news cycle than a buyer who needs the position to perform within the next few weeks or months. This is not because the multi-decade buyer is smarter in some abstract sense. It is because the time horizon itself filters out an enormous amount of short-term noise that would otherwise dominate the decision. Retail holders frequently borrow the conviction language of a multi-decade thesis, calling themselves long-term holders, while actually operating on a much shorter emotional time horizon underneath that label. The mismatch between stated time horizon and actual behavioral time horizon is, again, exactly the gap this video keeps returning to. The bear case is simple. A long time horizon does not eliminate risk. It only changes which risks matter, and a thesis that takes decades to play out can still be wrong. Spot. Bitcoin ETFs have seen real outflows recently, and the scale deserves to be stated accurately rather than softened. From mid-May through early June, the spot Bitcoin ETF complex recorded 13 consecutive days of net outflows, totaling approximately $4.4 billion, the longest redemption streak since these products launched. The single worst week inside that stretch, ending June 6th, saw roughly $1.72 billion leave in 7 days, and the 4-week total through that point reached approximately $5.4 billion. Numbers that size are not a minor data point buried in a footnote. Aggregate assets under management across the entire spot ETF category fell from roughly $104 billion to about $80 billion during the worst of the stretch, and total fund holdings dropped to their lowest level since shortly after the October all-time high. This is a genuinely large reduction in one of the market's most closely watched demand channels, verified through CoinDesk, Farsight Investors, and Soso Value data. Outflows like that feed the fear narrative directly, and in this case, the fear narrative has real numbers behind it, not just a scary headline detached from substance. The half of the story still missing from most coverage is not that the outflows are exaggerated. They are not. It is that ETF outflows and direct corporate accumulation are not the same buyers, and they are not always moving in the same direction even when both are real. One data set shows short-term, liquid sentiment-driven capital stepping back at meaningful scale. The other shows a multi-year horizon balance sheet continuing to add, in smaller size, even while that withdrawal was underway. Both things are true at once, and conflating the size of one with the direction of the other produces a distorted picture in either direction. The bear case applies here with full weight because this is not a case where the bear case is theoretical. A $4.4 billion 13-day outflow streak is a documented material reduction in demand, and if redemptions of that scale resume or accelerate, the support this video has spent time discussing could face real pressure, regardless of what any single institutional buyer does in parallel. Treating this outflow data as background noise would be a serious misreading of what actually happened over the past several weeks. Here's the mistake, named directly. Selling a position built on a multi-year thesis because of a 3.5% move inside a single news cycle is not risk management. It is panic wearing the costume of risk management, and the two look identical from the inside while you are doing it. The word irreversible is doing real work in this video's title, and it deserves to be earned rather than just used for shock value. A holder who sells $19,000 below their cost basis during a fear spike, only to watch the position recover months later, cannot undo that decision. The capital is gone, the tax event may already be triggered, and the psychological damage of having sold at the bottom often produces a second mistake, refusing to re-enter even after the evidence changes. This is the actual mechanism by which long-term holders become permanent underperformers. It rarely happens because of one catastrophic decision. It happens because of a string of smaller fear-driven exits, each one justified in the moment, each one irreversible the second it executes. There's also a quieter version of this mistake that never makes headlines, because it does not look dramatic from the outside. It is the holder who does not fully sell, but who shrinks their position by a third or half during the fear spike, telling themselves they are simply reducing risk. Months later, watching the full recovery they only partially participated in, that holder experiences a version of the same regret with none of the clean narrative of a total exit to learn from. And yes, there is a bear case to this section too, because intellectual honesty does not get a night off. Sometimes selling into fear is the correct decision, specifically when the thesis itself has actually broken, not just the price. The mistake is not selling. The mistake is selling without being able to articulate which one happened to you. There is an asymmetry worth naming plainly that most holders never think through in advance, only in hindsight. Selling too early into a recovery costs you upside you simply never participate in, which stings, but rarely threatens the core thesis itself. Selling too late, deep into a panic, after most of the decline has already happened, locks in the damage at close to its worst point while still leaving you exposed to having held through the most painful part of the move. Of the two errors, the second is the one fear-driven decisions consistently produce, almost by construction. Panic does not arrive at the start of a decline, when the cost of being wrong is smallest. It arrives near the point of maximum pain, after a meaningful move has already occurred, which means decisions made under panic are systematically more likely to lock in the worst part of the round trip rather than avoid it. Understanding this asymmetry in advance, before the pressure actually arrives, is one of the few genuinely useful things a holder can do with this information. It will not prevent fear from showing up. It can, at least, help a holder recognize the shape of the trap they are standing inside, while there is still time to do something other than panic. The bear case applies here without exception. Sometimes the panic is correct, the thesis really has broken, and continuing to hold simply postpones an even larger loss. Recognizing the asymmetry in selling patterns does not tell you which situation you are currently in. It only tells you to be suspicious of decisions made entirely under emotional pressure, regardless of which direction those decisions point. There is a well-documented concept in behavioral finance called loss aversion, and it explains more about this entire video than any chart does. People feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equivalent gain, and that asymmetry pushes decision-making toward avoiding further pain rather than toward maximizing long-term outcomes. Selling during a decline often relieves that pain instantly, even when it damages the long-term position. This is not a flaw unique to inexperienced holders. Trained professionals exhibit the same bias under laboratory conditions, which is exactly why institutional risk management exists as a separate, rules-based discipline rather than relying on individual judgment in the moment. The entire point of a written investment policy, decided in advance and away from the emotional pressure of a live drawdown, is to remove exactly this bias from the decision. Retail holders almost never have that kind of written policy. Most conviction is informal, untested, and built during calmer periods when no real pressure existed to challenge it. That gap between informal conviction and tested conviction is precisely where this entire video has been pointing. The bear case here is narrow but real. Understanding a bias intellectually does not automatically immunize a person against acting on it, and plenty of people who can explain loss aversion perfectly still sell at the worst possible moment when their own money is on the line. Knowledge of the trap is not the same thing as avoiding it. If loss aversion and panic-driven exits are the disease, The closest thing to a remedy is deciding, in advance and away from any live pressure, exactly what conditions would actually change the thesis. That decision needs to be specific enough to be useless to the version of you that is currently scared. A vague commitment to hold long-term is not specific. A written list of the precise on-chain, macro, or fundamental conditions that would justify exiting is closer to something that can actually hold up under stress. This is the same logic institutional risk desks rely on, formalized into something an individual holder can actually use. The point is not to remove judgment entirely. The point is to make sure judgment gets exercised in a calm moment, reviewed later in another calm moment rather than improvised fresh every time price moves 3% in a day. Most holders have never done this exercise, which is part of why panic feels so disorienting when it arrives. Without a pre-committed framework, every decline becomes a fresh, unstructured emotional event, evaluated from scratch under exactly the conditions least suited to good judgment. The bear case is that even a written framework can be abandoned the moment real money is actually on the line. And having a plan on paper is not the same as having the discipline to follow it when it counts. Every prior cycle in this asset's history has produced at least one moment where price tested the 200-week moving average under conditions of extreme social fear. Every single time, the loudest voices in the room were the ones calling for capitulation. And every single time, a smaller, quieter group treated the same test as an entry rather than an exit. This is not survivorship bias dressed up as analysis. It is a pattern visible directly in on-chain accumulation data during each of those prior windows, independently verifiable through the same chart providers cited throughout this video. The pattern does not promise a repeat performance. It does establish that fear-driven selling at this exact technical level has, more often than not, been the wrong side of the trade historically. What is consistent across every one of those prior instances is not the price outcome, since the magnitude and timing of each recovery differed meaningfully. What is consistent is the emotional texture of the moment itself. Confident declarations that this cycle was structurally different, followed months or years later by those same declarations aging poorly. That emotional texture is repeating again right now, word for word in some cases. History is not a guarantee, and we are not pretending otherwise. But history is also not nothing, and pretending the past several cycles carry zero informational value would be its own kind of dishonesty. The honest bear case to close this section. Past performance describes what happened, not what must happen again, and a market large enough to attract institutional Bitcoin treasuries and spot ETFs is structurally different from the market that lived through earlier cycles. Different structure can produce different outcomes, and anyone who tells you this time is identical to last time is simplifying a genuinely more complicated picture. Zooming out from this single week, it is worth placing this decline inside the broader multi-year cycle this asset has historically moved through. Corrections of this magnitude, even when they feel uniquely severe in the moment, have occurred repeatedly at multiple stages of prior cycles, both early and late. Severity of feeling and severity of structural damage are two different measurements, and conflating them is one of the most common errors made during any drawdown. None of this is offered as a timing tool, and using it that way would misrepresent the point entirely. The point is simply that a single sentiment-driven decline, however uncomfortable, is not automatically evidence that the broader multi-year structure has failed. Drawing that conclusion from one data point is exactly the kind of reasoning error this entire video has been built to expose. The bear case applies here with full force. Cycles are observed patterns from a relatively small sample size of prior instances, and a market this size now operates under meaningfully different participants, rules, and capital flows than it did during earlier cycles. Treating cycle analysis as destiny rather than as one input among several is a mistake in its own right. It helps to size this move against what holders have actually lived through before, rather than judging it purely against how it feels right now. This asset has a documented history of multi-month drawdowns considerably larger than the single-digit percentage move driving this week's panic, including stretches where price fell by well over half from prior highs before eventually recovering. None of those prior drawdowns felt survivable while they were happening, which is precisely the point. This comparison is not offered to minimize what is happening now, and minimizing real concern would be its own kind of dishonesty. It is offered because perspective is a legitimate analytical tool, and a holder who has never studied the size of prior drawdowns has no real basis for judging whether the current one is unusually severe or simply normal volatility wearing a scarier headline. The bear case applies in full here as well. Surviving prior drawdowns is not the same as guaranteeing survival of this one, and a sample size of a few prior cycles is not large enough to treat as statistical law. Each drawdown has had its own specific causes, and assuming this one resolves the same way simply because previous ones eventually did, is the same reasoning error this video has been warning against from the start. There's a trap on the opposite side of panic selling that deserves its own attention because this video would be incomplete without naming it. Holding a position purely out of stubbornness, refusing to even consider that conditions might have changed, gets dressed up in the same language as genuine conviction, and the two are not the same thing at all. Conviction is the product of an examined thesis that has been tested against new information and still holds. Stubbornness is simply refusing to look. The practical difference shows up in how a holder responds to disconfirming evidence. Someone with genuine conviction can articulate specifically what would change their mind and can point to evidence they have actually weighed before deciding it does not change the underlying thesis. Someone operating on stubbornness alone tends to dismiss any disconfirming evidence automatically, treating every piece of bad news as noise regardless of its actual substance. This matters directly to everything covered earlier in this video, because the same fear-driven panic this script has spent most of its runtime warning against has a mirror image failure mode. A holder too proud or too attached to admit a thesis has genuinely broken, can ride a position all the way down while telling themselves they are simply being disciplined. Discipline without reassessment is not discipline. It is denial wearing a more flattering name. The bear case here closes the loop on the entire video. Neither panic selling nor blind holding is inherently correct, and the actual skill being asked of any serious holder is distinguishing, in real time, which failure mode they are currently at risk of falling into. That distinction is hard precisely because both failure modes feel, from the inside, exactly like rational behavior while they are happening. Everything covered so far has been external data: price, sentiment indexes, filings, flow numbers, macro context, and cycle history. The hardest variable in this entire story is not external at all. It is internal, and it is the one factor none of these charts can measure for you. Ask yourself honestly what you would do if this fell another 10% from here. Most people answer that question with the version of themselves they wish they were: the calm, disciplined, long-term thinker who buys the dip and sleeps fine at night. The actual data on retail behavior during real drawdowns tells a very different story than the one people tell about themselves in advance. This is the exact gap this entire video has been circling. Strategy did not need to imagine how it would behave under pressure because the filing already shows what it did. Most individual holders have no equivalent record, just a comfortable assumption about their own discipline that has never actually been tested under real conditions. There is a difference between believing you have conviction and having evidence that you do. Belief is cheap, untested, and almost always generous to itself. Evidence requires something closer to a real measurement taken before the next test arrives, rather than after it has already cost you something. It is tempting to want this video to end with a clean resolution, a clear answer about whether the next week brings relief or further pain. That resolution is not coming, and any video that pretends to offer it is not being honest with you. What can be said, honestly, is that the variables covered here, the 200-week test, the on-chain holder split, the sentiment extremes, the macro backdrop, and the institutional buying pattern, will keep evolving in the days ahead, and each new data point will either reinforce or complicate the picture presented tonight. The discipline being asked of you is not to predict which way those variables move next. It is to keep watching the same sources, the same filings, the same on-chain data, rather than switching to whichever source happens to be telling you what you currently want to hear. Conviction maintained through consistent information, sourcing looks very different from conviction maintained through selectively avoiding anything uncomfortable. Whatever happens next, the gap this video has been circling between assumed self-discipline and tested self-discipline will still be there the next time price moves sharply in either direction. That gap does not close on its own simply because this particular news cycle passes. It closes only when a holder actually goes looking for evidence about their own behavior, instead of continuing to assume the comfortable version of the story. There's a final piece of this puzzle worth addressing directly, because it cuts against the instinct that produced most of the fear driving this week's decline. Markets generate an enormous volume of signals constantly: price moves, sentiment readings, flow data, social commentary, and the overwhelming majority of those signals are noise rather than information that should change anyone's actual position. Treating every single one of them as actionable is its own kind of error, distinct from but related to the panic selling. This video has spent most of its time addressing. The discipline being described here is not passivity, and it should not be confused with simply ignoring risk. It is the much harder skill of distinguishing which signals genuinely warrant a reassessment of the underlying thesis from which signals are simply the normal background static of a volatile asset doing what volatile assets do. A 3% move inside a single news cycle, absent any structural catalyst, sits firmly in the second category for almost any holder operating on a genuinely multi-year thesis. This is precisely the discipline that separates the institutional buying pattern documented earlier in this video from the retail reaction pattern visible across social platforms over the same 48 hours. It is not that one group has access to better information in real time. It is that one group has pre-decided which categories of information actually warrant a change in behavior, and the other group is making that decision fresh, under pressure, every single time price moves. Building that same discipline as an individual holder does not require institutional resources or a research desk. It requires a written, specific, advanced understanding of what would actually break your thesis, reviewed periodically when you're calm rather than improvised when you're scared. Most people who watch a video like this nod along with that idea and then never actually write anything down, which is exactly why the same panic shows up again at the next decline, regardless of how many times the lesson has technically been heard before. The bear case applies here in full, as it has throughout. Discipline about which signals matter can also become an excuse to ignore a genuinely important warning sign simply because it is uncomfortable to act on. The goal was never to dismiss signals. It was to evaluate them deliberately in advance rather than reactively. In the moment a headline or a red candle triggers the oldest instinct any of us have. We have walked through the verified crash, the 200-week test, the on-chain split between short-term and long-term holders, the extreme fear reading, the macro backdrop, the institutional accumulation, the ETF outflow nuance, the behavioral finance underneath all of it, and the historical pattern. None of it tells you with certainty what happens next because nobody honest can give you that. What it does tell you, clearly, is that there is a wide and well-documented gap between how retail sentiment is behaving right now and how the largest, most transparent institutional holder behaved this same week. That gap is not opinion. It is filed, dated, and public. The only question left is which side of that gap describes you, and most people genuinely do not know the answer until the pressure actually arrives. Here's the uncomfortable part. Everything you just heard, the panic selling data, the gap between what retail is doing and what strategy is doing, the way fear spikes exactly at the moments accumulation historically happens, none of it matters if you can't be honest about which side of that gap you're actually on. Most people watching this video believe they're the disciplined long-term holder in the story. The data says most of them are wrong, and they won't find out until the next leg down forces the answer out of them. That's the entire premise behind the Diamond Conviction Test. It's free, it takes about 2 minutes, roughly 10 questions, no fluff, no sign-ups buried in fine print. At the end, you get sorted into one of 3 categories: diamond conviction, wavering holder, or paper hands risk. And for the first time, you're not guessing about your own behavior, you're measuring it. You've sat through the evidence. The only question left is whether you actually know which category you fall into, or whether you've just been assuming the comfortable answer. Link is in the description and pinned in the comments right now. If this kind of breakdown is useful to you, the most helpful thing you can do is subscribe, because we publish this same level of source-verified analysis every time the market moves like this. No predictions, no hype. Just the data and the discipline to sit with what it actually says. We will be back the moment the next data point changes this picture, whichever direction it moves. Until then, stay disciplined, stay verified, and stay honest with yourself about which holder you actually are.